line for our first of our Fed Watch conversations. Herald, good morning. Thank you very much for joining us. Before I ask you about how you expect the Fed to react, this fresh gush of bearishness on crude, do you think it will unleash a big round of sell-off in emerging markets?
Well, I think there's a couple of things going on. Crude is one issue you should highlight, and of course also the upcoming Fed decision next week. And both of them are could be indicative or could be bad for emerging markets. Insofar, crude, the weakness in crude is a reflection of weak demand globally. That's bad for emerging markets. And of course, if the Fed is going to raise interest rates, in a sense, you could argue that's bad, although the question is in how far that's being priced in, or that is being priced in as we speak. If I look at the screen at the moment here, I see a lot of red numbers. The only one which looks positive so far this morning in Asia is I believe Singapore, which is a bit of a defensive market, but for the rest there's a lot of red. So I guess we're in the process of pricing all of this in.
All right, Herald, morning. You've been cautious on the Indian markets for a while now. In the recent past, since we spoke last, have you gotten incrementally negative? And what would your advice be to investors on the Indian markets?
I'm still cautious on the Indian market, but actually I would say I'm becoming incrementally slightly more positive, but it's not enough yet really to go away from our underweight position. So our view on India has been that earnings would disappoint and that reform momentum would be substantially slower than what people expected, and that the scope for substantial rate cuts would be somewhat limited as well. And to a large extent, all of that is worked out, so we can tick those boxes. What I still need to see is some sense of capitulation, or that the large holdings people have in India, that they're starting to come down. And actually, I see that coming down as well. So on the margin, actually, I believe India, in that sense, starts to look a little bit more attractive. But for me to say this is the time to go back in India, I need to see more attractive valuations. The market has come down. Unfortunately, the valuations have gone up because the extent of earnings downgrades we've seen in India has exceeded, is larger than the extent of the decline of the market. So I need to see those PE ratios come down, and in conjunction with that, also, foreign holdings of India to be diminished as well. And if we see that, then I think it's time to be starting to become more optimistic on India, but that's not really the time yet.
Herald, now about the Fed. Does the jobs data make the Fed action now imminent? And if that is the case, how come emerging markets didn't show that kind of a fright that one expected they would on the eve of a Fed rate hike?
Yeah, I think maybe two things going on here. So first of all, yes, we do believe that in December there's a Fed rate hike coming through. The biggest risk to markets, in a sense, you could argue, is that the Fed is going to be wrong. That if we were talking, say, 6 or 9 months' time, that we said they should not have raised interest rates in December that year because the underlying data in the U.S. comes through much weaker than expected. I don't think there's a risk. I think actually it could surprise on the upside in terms of the strength in the U.S. But let's assume for the moment that it is the case. And what you see with oil, for example, high inventories in the oil industry, if that's an indication of weak global demand, you can argue that maybe that is the case, that demand conditions are weak and that they're raising interest rates in such an environment. That would be very negative for emerging markets.
So will India continue to underperform developed markets for the next, say, 3 to 6 months? And do you at any point in time see India resume the downtrend to the recent lows of 7,500 that we hit?
I do think that India will continue to underperform, yes. And that's on the back of a realization that domestic growth won't be as strong as what people initially were hoping for. And there's both GDP growth as well as earnings growth for a variety of factors. That the CAPEX cycle is not recovering. That was all part of getting earnings to recover as well was partly driven by the CAPEX cycle in India, and that is not taking place. So I think being underweight on India is still warranted for the next probably 3 months or so. As I said earlier on, really for me to say this is the time to really start looking at India is when I see some sense of, I wouldn't say capitulation, but really that the large foreign overweight positions and the high valuations in the market, the high PEs, starting to diminish, and that the valuations look more interesting and that a lot of people have switched out of it. That I think is the time to say, no, it's time to go back into India.
Okay, finally, Herald, in the run-up to December 15th and 16th, would you expect emerging markets to get wobbly? If that rate hike is indeed announced, what's next for emerging markets? Will there be more volatility?
Presumably, yes. Initially, I actually thought that maybe a lot of this has been priced in and maybe we wouldn't see that much volatility. But as I look at the screen at the moment, there is a substantial amount of volatility in markets from day to the other. So we're in the process of starting to price in this Fed rate hike. Afterwards, I think there will be continued volatility as well, because on the 16th of December, that means after the Fed has raised interest rates, the question will move from when are they going to raise interest rates to when is the next one and how much will come through. And that's going to determine if the next one is quite soon and we see a substantial amount of Fed fund rate increases in 2016, that's extremely negative for emerging markets, in particular if it comes against a backdrop of actually weak growth. What could be positive if we find out that they're not going to do too much for at least another 6 or 9 months or so. So we only see maybe one rate hike. So, yeah, as the market swings between those two scenarios, we're going to see more volatility also beyond the 15th of December.
All right, we leave it at that. Herald, thank you very much for joining us. Well, that has been the key takeaway of most experts, that more than the rate hike, it is that dot chart, that is the expectation of how many more rate hikes will follow, that will rule the market's thinking.
All right, well, the key takeaway is also the fact that he's not yet reached a stage where he'll